Trade tensions with China are on the rise again. So how will your portfolio weather the storm? Stay to the end to see which market sectors will outperform, whether small caps are just catching up or ready to lead, and if credit markets are showing signs of real trouble beneath the surface.
The Fin 5, it's what they delivered. It's historic. Now, you can make the argument that it's backward-looking, but still, in a lot of the guidance, we didn't hear tangible evidence that there's going to be a reversal in the earnings. We heard what we all feel: cautiousness, a degree of anxiety about what might be ahead in 2026, about stretched valuations. But lastly, look at price action for the Fin 5. Each one of these 5 money center banks, they delivered their earnings, they spoke to the market and the analyst community, and where is price subsequent to that? Has price continued post-earnings to decline in a good news, bad price action formation? No, it has not. You could look at JP Morgan and say, okay, you didn't get any follow-through. You could look at Goldman Sachs and say, you didn't get any follow-through to the upside. But more importantly, you didn't get a significant breakdown. And then, oh, by the way, there's Morgan Stanley, there's Bank of America, there's Citi, and there is the remarkable historic earnings in the case of Morgan Stanley that was delivered today. And it's universal. It's wealth management. It's trading revenue. It's investment banking. So sitting here having a long-standing overweight to the financial sector, I'm not particularly sure if the market's given me evidence to suggest it's time to reduce that in a dramatic fashion.
All right. To your point, I believe we have a wall. Beats across the board for all the financials that have reported so far. You mentioned the names, Bank of America, BlackRock, Morgan Stanley. Steph, I want to come over to you. I thought today Morgan Stanley's report, where we saw trading revenues, a very big jump, up 35%, was very notable. A lot of that's due to some of the economic uncertainty that we've had due to trade and tariffs, inflation, and a number of other things, but still a very great report. Going ahead, do you see the banks continuing this kind of performance and continuing to power the markets as they are today?
Absolutely. I really think that they are benefiting from a lot of different things. Net interest income, net interest margin. The guidance from just about every one of them was higher for the fourth quarter and higher for 2026. We haven't had a cycle where net interest income has been higher. We haven't had it in many, many years. So there's that. There's deregulation. That will help the capital levels. That will lead to better loan growth, and in addition to higher buybacks and dividends. The Fab 6 actually have $192 billion of buybacks still left on what they announced last quarter. So I think you're going to see more of that as well. And so, of course, capital markets and M&A, that also helps. The most impressive number to me at Morgan Stanley, ROTCE at 24%. That was even better than JP Morgan, best in breed company in the banks sector. Morgan Stanley is back by far, but across the board, very encouraged about what we learned about the consumer, about credit, about delinquencies. The delinquency rates are running in the 2s. Not even close to, you hear the numbers are inching higher, not even close to distressed levels. So I like them a lot.
All right. Jim, I want to come over to you. Citibank, another pretty strong report right there. It really seems like consumer resilience. That seems to be the theme of this banking earnings season. That's obviously a very good sign for the economy. Is that also a great sign for the market, the fact that we're seeing a strong consumer? And in your mind, what parts of the market does that hold up the best? Obviously, financials are getting a boost from a stronger consumer, but what other parts?
Okay, so Citigroup was a very good earnings report, and it was sort of across the board, all business lines, including consumer, which is where you started your question, Frank, but it certainly included M&A activity, IPO, trading, you name it. As far as where we go from here, I said this to you 2 days ago, Frank. I'm going to stay on target with this, that I do think we have to watch credit spreads. Now, I feel like, I'm early on this, and I want to be wrong. Believe me, I want to be wrong in terms of starting to turn my attention towards credit spreads. I'm looking at the Bank of America high yield option adjusted spread index right now, and it's up about 35 basis points over the last 2 weeks. Now, we know why, and frankly, it would be inappropriate if it weren't up a little bit. It's on the back of this First Brands and Tricolor news, which Jamie Dimon was talking about, and I think he used the right analogy. Look, when you turn on the lights in the kitchen late at night and you see a cockroach, that's not the only one that you're going to see. So all I'm saying here is things look very good in the banking reports, but we have to keep an eye on what the future holds, particularly with underwriting standards. It will show first in high-yield spreads.
Jim, by the way, I know you said you want to be wrong. Well, you're a little bit wrong, because I remember on Monday. Let's go back to Monday just for a second.
Fine, I'll take it.
We talked about this, and I asked you guys, because I've been talking to some private credit people, are we going to hear some signs of concern about the credit markets in these bank earnings? You guys said no, we're not going to hear it. And then now you're referring to that Jamie Dimon quote. That's not an original line by you. That's a Jamie Dimon line about seeing the roaches.
Honestly, as much as I want to be wrong, you're not quite giving me comfort, Frank, because what you're saying is everybody's saying, get out of here. Don't worry about it. Look, I'm old enough to have heard that before, and I'm just telling you, I'm going to watch it.
All right, Joe, any change of heart about after what we heard from big bank CEOs? Pretty much all of them address the credit issues out there right now, either directly or indirectly related to First Brands and Tricolor.
I think there's facts and I think there's feelings, and I think a lot of people share the same feel towards where we are. You look at every asset class and you can make the strong argument that valuations are full. So at some point, at coming up on 100 trading days without a 5% correction, you're going to see the elevated volatility. You're going to see the price correction. I just believe it's a 2026 event. You know, everyone's talking about the breakout in the Russell 2000, the IWM. Mike Santoli did a phenomenal job on the network within the last hour, really talking about what the composition is for the IWM and how much that has changed to being even more defined as less quality and more junk. What does it mean, though, that it's breaking out? I think it means it validates that there is in place this bullish sentiment that is probably going to be well entrenched through the remainder of the year. And I think it means that you will get that chase for performance. The chase for performance in 25 ultimately will happen. So I think going back to your initial question, everyone feels the same thing. Yeah, we understand where we are, but then there's the reality of investing. And show me the tangible evidence that says right now, I need to move away from my equity holdings. I need to move in cash, because that's been a fool's game over the last several years that so many have pontificated about.
You don't fight the Fed. And the Fed yesterday said they're going to cut probably 2 times for the rest of this year, and they're getting rid of QT. You don't fight that. That is very, very powerful. You have $7 trillion of cash on the sidelines in money market funds. So you have the fourth quarter, which is seasonally the strongest of the year. You do not fade this rally. You actually do chase. And only 30% of portfolio managers are beating their benchmark. That's why you're going to see the chase.
And you're talking about the broader rally. I want to go back to the small caps for a minute, since Joe brought them up. Liz, you were on a couple weeks ago, and you talked about small caps being a catch-up trade. Do you still see it that way? They're really on pace for a second all-time high in 2 days right now, and we're seeing part of the other equity, the other major indices, I should say, pulling back a bit and seeing a lot of volatility.
So, yeah, and actually I think that was a little bit of a spat between Jim and I, the small cap thing, whether they were going to outperform or if it was just to catch up to large cap. So what I talked about then was, if we are in a Fed cutting cycle that is an adjustment cutting cycle, meaning they're just cutting to get back to neutral, they're not cutting because there's a recession or some problem that they're trying to save us from, typically large caps actually do better in that scenario. Small caps tend to outperform coming out of a major drawdown, coming out of a recession. This period, because small caps have just recently hit a new all-time high, and that was the first one since 2021, they are catching up, right? The S&P right now is at, I don't even know how many all-time highs this year, more than 30, I believe.
I believe, yeah, a few dozen.
So they're catching up to that performance, and there are a few tailwinds. I know that there are a lot of small caps that are non-profitable, and those have been the ones that are leading this small cap rally. But the tailwinds are that, as Steph mentioned, financial conditions are continuing to loosen. But that's probably not going to slow down, especially if the administration gets what they want with the seats on the Board of Governors next year. The Board of Governors puts the other governors in place, right? All of the regional Fed chairs in place. If that all is set up the way that they want it to, we're looking at a very dovish Fed in 2026. Not to mention, as we get clarity on tariffs, I mean, small caps are kind of insulated from that, so they're not feeling as much volatility on all of this geopolitical news. So there are good tailwinds for small caps going into that, but I do maintain it is still a catch-up trade for what large caps have already done.